How accurate are stock market predictions? People who make financial projections often sound overly confident. However, meteorologists frequently sound uncertain, if not wishy-washy, about their own forecasts. Do you know why? For two reasons. Financial forecasters appear far more confident. To begin, they do not provide a time frame. Sure, gold will rise in price at some point, and while Bitcoin may fall this year, it may eventually reach $200,000. You can never prove any of these forecasts, as long as they adhere to the golden rule of financial forecasting. Give dates or numbers, but never both. The second reason these financial forecasters may appear confident is that they are attempting to sell you something. Confident people are more likely to persuade us as humans, but be wary of prophets who want to take advantage of you. The meteorologist, on the other hand, is predicting the weather for the following day. If the next day's storm turns out to be the storm of the century rather than a minor snowfall, viewers will remember the incorrect forecast that stranded them on the freeway, at the airport, or at work for days. That is why meteorologists provide a probabilistic forecast and frequently discuss what could go wrong to cause the forecast to be incorrect. Forecasting financial markets is far more difficult than forecasting the weather. In fact, it's extremely difficult to explain past market performance. The broad Wilshire 5000 index in the United States gained more than 53% in 2 years ending December 31st, 2021, including dividends. In 2020 and 2021, we had a pandemic that didn't seem to end, rising unemployment, massive deficit spending, a widening political divide, inflation not seen in 40 years, and China and Russia causing extreme uncertainty. Markets thrived, making us all look foolish, and the message is that if we can't explain the past, we should be humble and uncertain about predicting the future of financial markets. Here's an example of a much better forecast from Vanguard. Vanguard forecasts that US stocks will average only 3.3% annualized gain over the next decade. What makes this forecast unique is that they assign probabilities to that expected return, with a 5% chance that stocks will earn 10% or more annually, and a 5% chance that stocks will lose 3.4% or more annually. Not only are the ranges quite large, but there is a 10% chance that the actual results will fall outside of even these broad ranges. There's also the martingale style. Another possibility is that past returns just don't matter. Paul Samuelson studied market returns in 1965 and discovered that past pricing trends had no effect on future prices, reasoning that such an effect should not exist in an efficient market. He came to the conclusion that market prices are martingales. A martingale is a mathematical series in which the current number is the best prediction for the next number. In probability theory, the concept is used to estimate the outcomes of random motion. Assume you have $50 and want to bet it all on a coin toss. How much cash will you have after the coin toss? After the toss, you may have $100 or $0, but statistically, the best prediction is $50, your original starting position. A martingale is a method of predicting your fortunes after the coin toss. Stock market returns could be assumed to be martingales in stock option pricing. According to this theory, the option's valuation is independent of past pricing trends or any estimate of future price trends. The only stock-specific inputs are the current price and the estimated volatility. A sub-martingale is a martingale in which the next number is more likely to be higher. The motion is known as a random walk with upward drift in popular literature. This description corresponds to over 80 years of stock market pricing history. Despite numerous short-term reversals, the overall trend has been upward. If stock returns are essentially random, today's market price plus a very small increase is the best predictor of tomorrow's market price. Rather than focusing on past trends and potential momentum or mean reversion, investors should instead focus on managing the risk inherent in volatile investments. Then there's the search for value. Value investors buy stock at a discount and expect to be rewarded later. Their hope is that an inefficient market has underpriced the stock, but that it will correct itself over time. The question is whether this occurs. And why would an inefficient market make such an adjustment? Although there is little evidence for why this mispricing and readjustment occurs, research suggests it occurs on a regular basis. In 1964, Jean Fama studied decades of stock market history and, with subsequent collaboration with Kenneth French, developed the three-factor model to explain stock market prices. The most significant factor in explaining future price returns was valuation as measured by the price-to-book ratio. Stocks with low price-to-book ratios delivered significantly better returns than other stocks. However, studies have not explained why the market consistently misprices these value stocks and then corrects them. One possible conclusion is that these stocks carry additional risk, for which investors demand additional compensation for taking on additional risk. Because price drives valuation ratios, the findings support the notion of a mean reverting stock market. As prices rise, valuation ratios rise, and as a result, future predicted returns fall. However, the market PE ratio has shifted dramatically over time and has never been a reliable buy or sell signal. In conclusion, even after decades of research by the best minds in finance, there are no definitive answers. A reasonable conclusion is that there may be some momentum effects in the short term and a weak mean reversion effect in the long run.